Hey, welcome everybody. This is Brian at Energy Rogue, and I've got a special partner, collaborator, and all around an amazing individual, James, over at ArcisFX. James, you want to say hi?
Hey everyone, nice to see you. I'm sure some of my familiars will be here, and it's really great to be here with you, Brian, as always.
Yeah. So today we're going to talk a little bit about OPEC Plus. They had their meeting scheduled for November 26th and they delayed it to the 30th. So it is going to be happening on the 30th and they are going to live stream it. So if you go to OPEC.org, there should be a link over there to watch the live cast. So they delayed the meeting, and that's what we're really going to talk about today because that really impacts some of the fundamentals around crude oil. And we're going to talk through OPEC Plus, where we are on production, what's in store for demand side for 2024, and what the supply side, both in the US and OPEC Plus, will really do, because that is really the balance that is going to drive a lot of price direction. And then we're going to end with James that is going to cover all the technicals in the market that are going to impact the market. And so based upon this meeting, there's probably going to be some volatility. So you need to be ready. And that's where James's insight on the technical side is going to be really key. But let's first start off and kind of set the stage. I'm first going to talk about US because it's quick and it's easy and it's one variable. And please, along the way, add some questions. We are going to cover those towards the end, and so feel free to ask questions. Anything that you want to know, we're gonna cover. We're going to tell you whether we know it or not. So first, I want to cover the U.S. production. Many people have been talking about this rapid growth in production from 12.2 million barrels a day all the way up to 13.2. A couple of notes here. Number one, we've been dropping rigs. Number two, this increase coincided with a way that the energy information changes how they report their crude oil. So, and crude oil production. So, part of this move up from a fundamental supply side of the equation for the US, it's not an additional million barrels a day. And another fact, out of 13.2 million barrels a day, 6 million barrels a day are natural gas liquids. And that's part of the reason that when we look at, let me get back to the dashboard here. When we look at the supply demand equation, we import in the United States, we import over 6 million barrels a day, but we also export over not over 4.8 million barrels a day. And we did have a special guest with a Christmas tree in the background coming in. Bill, you want to say hi to everybody?
Hey, folks, how you guys doing? Can you hear me, Brian? Can
Yep,
you hear
I
me?
can hear you. The video's a little choppy, so
All right.
it might be the Wi-Fi connection.
I am coming to you from Taos Mountain Outfitters on the plaza in Taos, New Mexico. They've been kind enough to allow me a couch and a warm place to sit. And if you are ever come to Taos Mountain Outfitters got the best stuff around, and they are like us. They know how to treat customers.
Okay,
So
great. Well, and
there's their
make sure
commercial.
you put their web link in the comments, and we're getting started a little bit with the supply side of the equation on the U.S. supply. And when I look at where we are on the production side, as I said, yes, we have grown production. However, the leading indicator is that we've dropped an enormous amount of rigs since June, and that is going to have a supply impact.
Right.
To date, it hasn't had an impact yet, but it's coming. And now when rigs are dropped, it's not a straight line. There is a delay effect both when you add a rig and when you drop a rig. And that delayed effect will take anywhere from 3 months to 12 months. So that's where we are on the U.S. On the U.S. side of the equation. So I would say the forecast for 2024 for the U.S. is probably going to be a drop in production, which means OPEC plus is really going to be an important variable. And when we talk about, before we talk about OPEC plus and the supply side of the equation, I do want to talk a little bit about the economic growth forecast. This is OPEC's economic growth forecast. There are different forecasts for different countries, different organizations. I actually like the OPEC vision of what the economic forecast is looking like. In 2023, a 2.8% global growth rate. In 2024, they're projecting a 2.6, but I do want to show something interesting since I'm in the US. The US had a 2.3% growth, but in 2024, a 0.9% growth. And the Eurozone is expected to increase, but that is projecting what most analysts are talking about, which is a potential recession. And that's the reason that OPEC Plus and this meeting are taking front and center on what the supply side may do. So let's first take a look at where we are on the OPEC side of the equation right here. Okay, so this is one of our charts. This is our platform, Energy Rogue. If you really want to understand some of the energy fundamentals for supply, demand, imports, exports, storage, stocks for crude oil, natural gas liquids, refined products. We have a product for $89 that gives you access to over 150 charts that are interactive and downloadable so that you can analyze and assess the market. And so if you look at the 5-year range, we are right in the middle of that 5-year range where OPEC, I track OPEC because the OPEC plus part is really more about Russia, and we're going to talk about Russia a little bit differently there. But OPEC is currently delivering 34 million barrels a day. 5-year max has been 38 or 39 million barrels a day. Now, a lot of people talk about spare capacity, but I want to be clear on something. We look at spare capacity as really what is the high point of what they've produced in the past. That is really a relevant factor to us. And it's really at the 5-year highs, just over that at 39.6 million barrels a day. And we're currently at 34. So now let's take a quick look at OPEC and OPEC plus. Now, this is a little busy. I threw this together this morning, but I really wanted to demonstrate or show a little bit about some of these variables. This is the current production targets for each one of the OPEC members, the 2024 targets, and this is the delta for the targets. This is not production. This is the OPEC supply quotas. This is what they agreed to back in June. This is what they're going to discuss tomorrow or later tonight in about 10 hours. So one of the key variables to look at here is if you look, the supply quota went down for Nigeria. That's one of the variables in play, as well as Angola. Those have been two vocal African countries that have been pushing back on extending supply cuts. They don't want constraints because that does impact their economy. So those are two variables to look at. The one key variable is that Saudi Arabia currently has 1 million barrels a day of voluntary cuts in addition to their supply quota. Currently, on the production, I pulled October production because that was the latest production numbers we had. Every one of the OPEC nations, with the exception of Gabon, is underneath their production target, their production quota. So they are under delivering their current allotment. And Saudi Arabia is by far the largest at roughly 1.5 million barrels a day. But if you add up all these, we're over 2.3 million barrels a day underneath what the current quotas are set. So there could be a supply cut or a further cut that actually matches production, that gives the optic that production was cut, but that may not be what is actually happening. One of the key variables to watch, and it's unfortunate, but there's just not a lot of good data coming out of it, is what is happening in Russia. The latest numbers, Russia production or Russian exports are about 300,000 barrels a day above where they were last November. Now, most people have been calling for a drop in Russian production, and that hasn't happened yet. And if it hasn't happened by now, I don't know if it will happen. So they are actually stimulating some of the fields, and that's one going to be a key variable. So the key variables that I look at are Saudi Arabia, Russia. I do look at UAE. Some other variables to watch are Venezuela and Iran. We'll cover those separately, but I wanted to open it up to Bill and James and see if they had any thoughts on that, because I threw a bunch of stuff out there. So do y'all have any thoughts on that?
Go ahead, James.
I don't know, Bill. Do you want to go first?
No, you go ahead there. I'm going to listen to you and see if I can figure out some way you're wrong.
Oh God.
Yeah. So I don't know what the story with this potential supply cut is from Saudi, or what effect it might have. It seems to me, looking at the charts, that there is some concern about it. But on the other hand, they're also talking about getting rid of that supply cut and perhaps even increasing production, in order to drop the price a wee bit. And this is kind of the way I gather it. I don't know, you'll know more than I do about this whole scenario. This is what I picked up from Wall Street Journal and Barron's and so on. It seems like the idea is to drive the price down, not up. And in doing so, getting rid of some of the smaller players, smaller countries, smaller suppliers and producers, which will in effect do the same thing as production cuts. So it's a sort of a long route to the same outcome. And that's trying to match supply and demand.
They did that in 2016. You know,
exactly.
Yeah. I think it was 2016.
Yeah,
Is
that's
that
exactly
when it
what
was?
say. They did that in 2016.
Yeah.
Yeah, it was, and that's when they drove the price down. That's when we saw the price get significantly cheaper. The idea there was to take a lot of the U.S. supply off the market by trying to keep the price below their lift costs. And they can do that, but they can't do it for very long. They can do it probably for 6 to 9 months at the most, and then everybody still has to pay bills. And
well,
so,
I think at $85,
what they do
were
is
still 2%. They were still 2% behind on their budget at 85. At Brent 85.
But Brent 85, that's right. But what I'm saying is that, so if they can drive it down for a certain amount of month, that gets the U.S. producers from continuing to let go of rigs. If that continues as we show the trends going down, to let go of rigs, what that's going to do is going to give the Saudis a break in that, and realizing, of course, we've talked about this before, that when you look at the crude oil numbers, about out of that 13, about just under 7 of it's NGLs. It's not crude oil.
Well, and this is what's happening in the U.S.
So
on rigs, right?
Yeah,
It's
I mean,
right.
that's
And
quite
so if you
dramatic.
see that little spike, you see a little spike. If you look at a little spike in rigs right there that we saw right there in just the last few weeks, several weeks ago, that was, if you remember, right, that coincides with a nice little spike in the price too. So it takes them about 30 days from decide to drill a well to get a rig on location. So that's what you see that little spike on, is that they finally got some rigs on location. My guess is they hedged out some, and that's why they got the rigs out. That's just a guess. That's more than a guess. It's speculation. But so I think the Saudis can bring that price down. But it's a real catch-22 for the whole OPEC group, because, you know, they're at best a loose organization as far as trying to come across these, because it seems like everybody in that group cheats. But the problem is that they keep their goals. They don't want to lower their goals, but they never attain their goals. And
Right.
so they don't want to be told they can't produce less, but what they can do is that even though they can't produce it. So it's a real catch-22 on trying to look at the charts and try to figure that out. But I think that what we see there, you know, I go back, the technicals can run you up and down, but the fundamentals are going to push a trend. And right now, based on the rigs, I think the fundamentals are pushing a trend that we're going to have less instead of more. Now, you got a demand situation that you have to sort of figure out along with that. That if you have less supply, if your demand goes down, it's not quite as dramatic on the price.
Right.
Well,
Right.
the
And
price will stay more. I think the objective is to keep the price around about 80 to 85 dollars a barrel by flooding the market,
Yeah, I
driving
think
out,
on
driving
Brent,
that.
yeah,
Yeah, Brent, yeah, and driving that number on the screen there down significantly further. And any potential price drops are offset by production cuts elsewhere, and other places like Nigeria and Gabon and Angola, who can't actually even meet their minimums anyway.
right.
So
And that's the
right.
key,
And
that's the key message there, is that when I look at this OPEC plus meeting, the two variables that I walk away with is I want to understand what Saudi Arabia wants to do, because they could add 1 million to 1.5 million pretty quick, and Russia. And so so Saudi Arabia could really surprise the market and turn it on. I doubt they will, because that will actually plummet the price significantly. And if we are on track for the recession, as everybody says, I tend to think contrarian, just because everybody's saying the same thing. But when I look at OPEC and OPEC plus, what I'm watching for, in I don't know how many hours, when they have their meeting, is Russia, Saudi Arabia, Venezuela, and Iran, who are not in the OPEC, but what they do is important. But I want to finish one thought on the US. We've dropped a lot of rigs, but we added so many from the COVID time to today, to the beginning of 2023, that we're just starting to see that this production is going to tip over, and it is going to drop, and there is going to be a response. And until we get back up over 800 rigs in the US, we're currently at 623. We're not going to see production growth. There may be week on week production growth, but it's about to tip over. In other words, it may grind up a little bit more because of deferred completions. But let's finish one thought, and then we'll go
Brian,
over.
and Brian,
sorry to interrupt, Brian.
this sounds
Yeah,
How does that chart look?
Sure, good.
Sorry, how does that chart look going back another 10 years? The
let's
rig
see.
count, sorry.
I don't know how far back this. Let's see how far back this goes. Oh yeah. Okay. So here we go. Let me increase this.
Yeah, I was going to
Okay,
say,
so this takes it back to 2000, and the red is gas rigs, and the oil is the blue is oil. So that is what we're looking at there. And as you can see, there were a lot of rigs chasing gas. Of course, during this period, gas was we were building LNG import facilities because we hadn't figured out the shale yet. And that's part of the reason we had so many gas rigs working. And if you map that to some historical natural gas price charts, you'll see in 2000, 2003, some spikes up to 10, 14. But then after that is when oil started really leading the charge. And when it started leading the charge, you could see that the associated gas really kind of came into play there. But what was your thought in taking a look at some of the history here, James?
No, it's just interesting that we're still pretty low. It's concerning that's a general downtrend. It's not going to go to zero.
Right.
Yeah, but
and it's also interesting. It's interesting to note the influence of the economy on, which I think people underestimate in general. So people say, well, the weather's turning good or it's bad or whatever, or price of gasoline's gone up a few cents or it's gone down a few cents, and that's going to, they trade based on variables which may not have as much as an impact as something like this, that you can see the effect of economic expansion or growth on the number of rigs, and you'll see it in the same way on the oil price.
These
and so and what is it? Sorry, Bill. It's difficult to sorry, it's very difficult to talk. But what I was going to say is we're actually heading potentially, perhaps not for another 3 to 6 months, but potentially we're heading for another economic downturn, and we're already pretty low on this rig count chart. So perhaps it's not heading up anytime soon, and demand is going to fall away, and the Saudis are looking at all of that and thinking,
well, and that's why their economic forecast, that's why this is a key variable. And this is in their monthly production. Just go to opec.org, and they have a monthly update. And this was published, I think, 13 days ago or 14 days ago, something like that. I read these every month, and it's super important to understand what they're actually doing there. But let's see. When we look, so U.S., I see Brian, supply is going to start tipping.
Going back to that height of rigs, remember that's pre-horizontal drilling.
Yep. It is pre-horizontal drilling.
Horizontal drilling didn't come around until about 2014, 2015. And that's when the rigs were able to, that's when you started hitting your rig efficiency that Austin had a question about in the chat. And so the rig efficiencies, though, are now beginning to tap out. They've done about as best they can. They're going out about 10,000 feet horizontally. They've gone into the third mile, which they're now trying to get out to 12 to 15,000 feet horizontally. But they're seeing that they're not getting the same return on that extra 5,000 feet that they got on the first 10,000 feet. And so because it's just so far out there, and they're not getting, I mean, they're 10,000 feet down and 15,000 feet out. And so it's hard to, their physics starts working against them. And so I think, Austin, that basically that the efficiency is probably, without some logical development, I think it's probably reaching its maximum. The speed that they're going down doesn't really, I mean, that changes how many wells they can drill. But if you don't have the rigs, if you don't have the wells to drill, it's hard to go ahead and drill those wells. As far as ducks, Brian can tell you on ducks, there's only one area where we really still have really any ducks of any significance, and that's gas, if I remember right. Brian, is that correct?
Yeah, let's actually take a look at it right now. And these are some of the charts that we actually track and have in our product that is, not to sound too salesy, but only $89 a month. And I'm going to show the ducks, which is the drilled and uncompleted. This basically, you build inventory because there's cash to drill the well and cash to complete the well. And we are on historic lows for ducks, for drilled and uncompletes. So there's not that many. Now, there can be something drilled in January that is completed in November. That's kind of part of the reason that there's not a one-to-one correlation to rig drops or rig increases. But I do have something else to mention here from Jay. Thank you for texting. As the oil basins age, they get gassier, so they produce more gas as an offset. Every basin is different. Midland is most pronounced, meaning it's going to get gassier over time, which means more NGLs, more gas, less absolute crude. It's not the gas that grows, it just declines a lot slower. So basins are getting gassier for two reasons. Number one, the reason is that they get gassier over time. Number two, people run out of high oil cut inventory and drill gassier benches. So that is actually a very bearish point for natural gas, and we're going to cover that in a later session. But I'm going to finish up an OPEC thought, and then we're going to pass it to James to kind of cover some of the technicals. But let's take a quick look at OPEC and where they are on production and where that might go. Because when I look at some of their most recent in 2018, 17, 18, they were around 37, 38. That was about 3 million barrels a day. If you actually track that back, there is a large delta from Saudi Arabia, but also a large delta from Iran and Venezuela. And both of those, let's actually take a quick look because I want to take these variables off. A lot of people look at these and say, well, Venezuela is going to come back and add 2 million barrels a day. It is not going to be an additional 2 million barrels a day for years. So Venezuela is not going to be a big variable. They have been grinding up. Maybe they're going to add a couple 100,000 barrels. Not going to be a big player in 2024. Iran, there's really not that much left to go. They've been increasing their production. A lot of people look at Iran when it was first started to be discussed. Yeah, there was 2 to 3 million barrels a day of idle capacity. There's not that much anymore. There's maybe 800,000, and that's if everything goes right. So Iran and Venezuela, I think, are non-impact events, and that's why Russia and Saudi Arabia are really going to be key. But the key message is they're currently 2.2, 2.3 million barrels a day behind their current production targets. Saudi Arabia is a million of it. So that's why I'm going to be listening to what OPEC Plus says tomorrow. But James, do you want to kind of cover some? Oh, go ahead. Go ahead, Bill.
I was going to say the Russian thing for me is that the articles I've been reading is right now operationally, Russia's running on the ragged edge. I don't think even if they have the oil to produce, that they operationally can produce it because there's not that many U.S. companies there to help them because of all the. I mean, if there's anything that the production bans or bans on Russia have had, it's the fact of U.S. companies going in and helping them get their production set up. There are still other countries who will do that, but I think they're really running on the ragged edge of keeping up with what they've got producing right now.
Right, right. And that's, yeah. So, and we do have one question on LNG capacity. So let me answer this before we pass it back over to James. But the discussion on LNG terminals in 2024, for reference, this is what we are looking at. We're currently just shy of 14 BCF a day. That's operational capacity that can be overrun. But if you look at early 2025, we're going to be up over 20. So it's an additional 5 to 6. So Mantis, you're right on target. There is going to be some additional LNG export capacity for that. And I answered that question, but I think that was directed to you, James, which might be a good segue.
Yeah, well, I'm glad you answered that. Thank you, Brian, because I don't know anything about it. So yeah, let's have a look at what we've got going here. And first of all, I've got to navigate to my charts, if I can do that. And we want to get rid of that. and go across here. So we're talking about crude, and I've got the WTI charts on here. I don't have Brent crude, but I haven't got that on here at the moment. But if you want to have a look at it, we can. But they're pretty similar as the last time I looked. Different pricing, but similar shapes. And this is where we are on Brent crude. So we were selling this from right from the top, and then we got out somewhere down here. Once we got up into this region, let me just backtrack a bit. Going back to, I'm going to change this to a weekly chart just to give you an idea of where we are. And there's a pretty good picture. That's 2021, Brian, and
Okay.
Bill. We dropped down to $8, if you remember that as well. I can't remember what happened then.
Well, that was during COVID, and the settlement.
Oh, yes.
The settlement happens at a physical location in Cushing, Oklahoma, and because of that, it actually went negative because there wasn't enough physical capacity to meet all the contract settlements. So
yeah,
a weird technical thing.
yeah. Okay, so and you know, if we go back to 2022 when we were up at $126, so the way I trade commodities in general is I look, as I was saying to Brian earlier, I look for it. I try to trade off extremes, and this is a weekly chart, and these extremes are quite clear, and we've got a big range that we've been in really since 21. The sort of entry into that range, that sort of spike up there during 2022, and we've come back down, and we've now got this very clear range between somewhere around about $90, where we peaked up recently. That's where we sold, and then down at about $65, which is where the 200 period moving average is at the moment. And then a few green lines in between just showing intermediate support and resistance levels. And so we've come down to this sort of zone here, and I'm going to go back to what I want to actually do is just clean up these charts. I'm going to remove all these lines. Yeah, so let's clean that. So there's the 200 period moving average, and there's a couple above us, the 50, the 20, and the 100. And we've come down to this level here. You can see I've got a little trade on here. This is a live account. It's just a demonstration account, which I use for my private trading group members to demonstrate my trade positions on my larger accounts. So that's where we got in at about $75.5 a barrel. And we're aiming back to somewhere near 90, maybe 88, 90, near the top of the range. And we'll be looking to sell again, perhaps once we get up there, especially with this news from Saudi and potential economic downturn. And if there is some market flooding, we probably, or even rumors of that, we probably won't get above this recent range extreme at around about $90. So we started buying at the bottom here, and we're just edging up. Now, let's go back to the day chart very quickly, and I just think this looks quite supportive. And so we had this move down through the support level where we bought, which is at $75. And we formed this sort of inverse head and shoulders type pattern, a left-hand shoulder ahead and a right-hand shoulder, and we've just moved up. We're still below all the moving averages, and we haven't even closed above the 20-day moving average yet. We've just poked through it now. We're at the 200-day
Did we break that down
average.
channel? Like you posted
Yeah.
that for your members. You posted that channel, and I was curious if we did or not.
Yeah, so there's a couple of channels you could draw. I mean, we could very basically just draw that one in there. So we've broken out of that downward trend line. Or we could put one from the top, I suppose. Something like that, which we'll eventually get to. And that's where those two moving averages are. So I think first stop will be somewhere around maybe $80, 82. And then we'll hope for a little bit more than that, 88, maybe 90. We've broken the first downward trend line, but we've got the 200 and the 20 above us, and then we've got the 50 and the 100 at that next trend line. So basically, it's as simple as that. And we want to be pretty nimble and flexible with it, because there are I think there are going to be a lot of changes going forward in interest rates, potential early cuts. I don't know. I think it's slightly unlikely at this stage, but there's talk of, and some pretty big players in the market are betting on that will be cutting in March.
They're already betting on the cut?
Yeah. So March is becoming, it's I think it's March the 5th I can't remember now. I put it up in Twitter. Somewhere in March, someone will know. You can put it up in the comments. But in March, whatever date that is, and there's another one that I think it's the beginning of May, which is quite a long time after that. And people are saying March. So, so we're going to get interest rate cuts, which normally tank the stock markets because it does exactly what everyone thinks it's not going to do. And it normally means that the economy is broken, which means that there'll be demand drops and all sorts of fluctuations. And then we've got dollar fluctuations, which do affect all sorts of commodities, particularly, metals, obviously, and some of the softs and the grains, but also natural gas. And it depends on the export-import balances and who's buying what and what the currency distributions are. But I think natural gas does tend to react, and oil does, of course, to the price, the value of the dollar, because it's priced in dollars. And a lot of oil is made produced in the US and purchased by the US. So the dollar affects all of that. So we're going to see changes in the stock markets, changes in the bond yields, changes in interest rates, and that's all going to have an impact on Brent crude. But also all this talk about OPEC Plus and potential. First, we were talking about potential cuts, which are still in place. Now we're talking about potential flooding. There's going to be uncertainty and doubt in the market, which generally, I think, in commodities like oil, uncertainty and doubt tends to push the price up rather than down. So I think that's generally all quite supportive for this instrument until we get to about $90, let's say, tops. And then we should be looking for...
And you're talking $90 on WTI?
On WTI, yeah.
Okay, all right.
So that would be the peak at around about on January the 26th.
Okay.
On WTI. So if we switch this to Brent crude, let's just have
because a lot of time the OPEC is looking at the Brent key.
Yeah. So here's the Brent chart.
Yeah,
you can see. So we traded this as well, and this broke down beautifully. This is absolutely classic. If you think technical analysis is a waste of time, you're right. Quite some of the time it is, of course, because we draw things that we want to see. We like patterns. That's what humans do. We like looking at pictures and patterns and try to fit everything. We like to make things make sense because they don't often make sense.
Right.
So we try to make them make sense. So when we draw these things in, we're trying to fit what we think should happen onto what is happening. But there is a role for it, and a very powerful role, I believe. And you can see how we broke the channel, forced our way down there, and we thought, everyone who thought they weren't going to be able to get short thought they were left behind. Then you get the people who FOMO into the market on this big move down, thinking if we don't get in now, we're going to miss it. But we just came back to the channel breakout a little higher than where we left. That's normal because the channel rises, and we got up into that resistance zone, which is determined prior to this by various other levels that we tested over time. You can't see it so well on this chart. You can see it over there. And then
it kind of looks like
again.
An inverse, a very big inverse, close to a head and shoulders inverse, doesn't it?
You're talking about this little bit down here.
Well, if you got the quadruple bottom as the head.
Oh, I see. Yeah.
Maybe.
Yeah. So
I
a big shoulder here. Yeah. So move down, big shoulder, a little head. So is that what you're talking about?
Yeah, maybe. I mean, I might be trying to make too much of it, but it looks like if that level gets above 91.5, I mean, it could really rip, couldn't it?
Yeah, sure. I don't think we're going to go. I don't think there's going to be enough economic oomph to take us back above 90 to 95. I don't think we're going to get to 110 or 120 or 130. But I think we could get back to 90 or maybe even 100 maximum. But I think 90 is about it. So that's up here in this green zone again, and there's no reason why we shouldn't rally up. Actually on Brent we're more towards the middle of the range at the moment. You remember on WTI we're close to the bottom of the range, but right. But we're above the 200. We're above the 20-period moving average. We've got these two other ones above us, the 50 and the 100. But I think, that even this little bit here looks like a head and shoulders too. So And I think generally given everything, and I think it's just going to be a
So-
ranged period where we're stuck between 90 and 70-ish for, it could be quite a while, months, could be into maybe March,
So-
April next year when the first cuts
Ja-
come, if they come.
James, do you think that the spread between WTI and Brent will break out even more as we go along? Especially with the U.S. being in election years, that sort of throws a wrench in everything.
This is the Brent to WTI spread that we track. So this is a daily. So it's a little choppy because it's kind of a daily thing, but this is what we typically take a look at.
Okay, that's useful.
But
Yeah. I don't know. Look, I'm just trying to draw the two on here. Quickly, just the orange one is Brent.
The orange one's Brent, and the yep.
Yeah.
Okay. Yep. I can see that.
So I'm going to get rid of these moving averages as well, just to make it clearer.
And thanks, Richard, for tuning in and talking about the rate cuts, because that is, and that's one of the reasons that James and his service at ArcisFX is something that a lot of people should take a look at, because with the focus of James's service is he looks at commodities, currencies, and he tracks all that stuff. We track energy. He's tracking economy.
So there's a line chart of blue, which is I'm assuming
blue would be Brent. And blue would be
Brent.
So the blue
is Brent crude, and the orange is WTI.
Yep.
Now you can see the correlation is almost absolute. It's almost 100%.
Right.
So there are points in time when Brent and WTI approach each other in price, and then they diverge as well. But in general, statistically, the other one does what the other one does, and there might be $1 or $2 or $3 difference in the spread from time to time, a variance in that difference. It's not much.
Yep. And this is kind of what it's looked like. But what's interesting is it did tighten up in October, and then widened back out, and it says it's about $4 right now, I think, something like that. Is that does that kind of jive with what you're seeing?
Yeah. So if you just switch back to my charts, you can see actually since October, it's been super close.
Right.
And it's widened a little bit recently. Okay. Going back to September and before, but August, September, there were quite big differences on a few occasions, really. But I think in general, I think if you're trading, my approach to trading oil is I trade one or the other. I generally tend to trade Brent crude, WTI, because I have more flexibility on those contract sizes for some reason with my broker. But also, I like to look at both of them. So keep an eye on. So sometimes you'll see a reversal signal on Brent crude, for example, which is really clear, a really good trade entry signal, which is perfectly formed and beautiful. And you won't see it simultaneously on WTI, just because of the fluctuations. But so a situation where I'm thinking about buying WTI or selling WTI, but I'm not 100% sure, I'll look at the Brent crude price and the chart patterns on Brent crude as well. And if I see there's a confirmation or a strengthening of my argument by looking at the Brent crude price, I'll take the trade on WTI. And I prefer to trade one instrument and not both of them. And I think you should just pick one and look at both charts and see if there's confirmation. If they're both showing fantastic reversal signals at the same time, you have a much better chance of a good trade. If
And,
one of
and
them
this might,
is, yeah,
this might be something. Have you looked at this one? Because WTI started being included in the Austin. Thank you for watching and thank you for commenting. The September prior to the addition to WTI, WTI was included in the Brent basket. I forget what proportion. It wasn't a lot, was it, Bill?
I think Bill has is getting outfitted with some snowshoes or something.
he's getting outfitted. Yeah, he might be. But oh yeah, he dropped off. He probably meant to hit a different button. But I do believe, Austin, that the WTI inclusion in Brent, it should compress back together. But when I look at the delta, I'm not seeing a significant shift in September. Of course, we did, let me show you this. We did kind of contract at the beginning of October. And that might be when that shift happened at the early October. I can't remember when
Sorry
that.
about that, guys. This
Oh, no
this
worries.
this iPad's hard to work with these new gloves.
I was right. Not snow boots, but snow gloves.
Yeah. So, so Austin, I think you are going to see a tighter relationship between the two, but as James said, there should be a one-to-one correlation, and that spread is probably not going to be as volatile as it once was, especially with the inclusion of WTI into Brent. But Bill, did you have any thoughts on that?
Yeah, once again, it's a basket, and I don't think WTI is affecting that much. Why I was looking at that spread, and I think the WTI will affect it as the spread widens out.
Okay. Okay. So I think what we'll probably do is we will open it up. I think we've covered most of the questions that have come through, but let's actually just rattle back through. Let's see, the boring channel. Hey, good to see you. Ant, good to see you. Tomas, I might be mispronouncing
Tomas.
that. Tomas, great to see you. And Block Media, yep, great guy, great trader. That James, that's why we're fortunate to have him with us today. So thank you, James. And Austin, hopefully we answered some of your questions on the ducks. If you have any other questions, you can reach out to us down below. We'd be happy to connect with you. Mantis, thank you. Hopefully we answered your question on LNG terminals and 5E. Hi, good to see you. And DeGhost, I love this screen name. DeGhost of formerly known as Mike Hunt. So DeGhost, thank you for showing up and thank you for being here. Richard, thanks for showing up and continuing to show up. Austin, again, thank you for commenting there. And hopefully we answered your question on WTI. And Tomas, let's see, I'm perfectly okay. Perfectly okay with Thomas. Thomas. I keep saying it differently. My neighbor is Tomas. So listen, thanks so much. I think the key message and the key that I want to leave with is there's going to be a lot of news in the next 24 hours on OPEC Plus. The key takeaway, OPEC members currently have a constrained supply quota, and that constrained supply quota holistically is being underdelivered by over 2 million barrels a day. That's 2% of the US market. So the key message is you might see a further supply cut. That may not translate to physical, so I want to be aware of that. And really for the short-term price direction, I would definitely follow James and see where we're going to head. I have my personal bias on where WTI is headed, which is 81.29. I think is the kind of key point that that kind of matches with what James is saying, and that's kind of the key point that I see us probably popping up to. And I think we're We've inched up a little bit there today, haven't we, James? Where are we right now?
Yeah, so I think I think that's obviously the next stop, because you say about $81, 81.20. That's around here. Sorry, around here, 81.20. So that's just at these previous swing lows, and some of these swing highs, and a bit of consolidation around that area here too, around $82.
So somewhere around
And
there.
yeah, and it's also the underside of this trend line, just about, I suppose. Yeah, so up to this trend line, and more or less where these two moving averages will come down to in the next day or two or three. This is
Okay.
the 50 period, the red one's the 50 and the 100, and we'll get up above the 200. So that's going to be the decision point, and I'll put a little marker on the chart there, just to people that watch my videos will know that I like my little circles everywhere. So that's the sort of zone for bulls,
Yeah.
I think, to start with.
Yeah.
And then if we can get above there, then so I think this is a sort of path we'll follow, something like that, and then a bit of faffing about. And the question will be whether we break up or we just carry on moving down. But I think we've got a good chance of getting up there somewhere.
Okay. And
Yeah.
then we'll have to see. So listen, I think that is probably going to be where we're going to close it off today. So to members of ArcisFX, thanks so much for joining the live stream, because we really
Absolutely,
try and
yes.
combine the fundamentals and the technicals, and really that is super important. And let's see, Thomas asked one final question. How about for natural gas, which today's topic was on OPEC, but let's talk about it real quick. Today went up maybe back to 280. We'll go ahead and let James speak to natural gas, but it does need, and Richard also mentioned this, it does need colder weather. The fundamentals just haven't been there. I mean, there's bearish fundamentals at play here. So,
yeah. So this is the chart. This is the weekly chart. It's quite a beautiful chart pattern, really. If you look at that downward sloping line, beautifully touching those highs and these lows, and then where we actually sold a few weeks. This is a weekly chart. So we were, if you've been following me, you'll know we started selling at the top here. We sold a couple of occasions. We got out a little early, I have to admit. We got out around about 290, I think, or around about $3, and then started buying at 285. Actually started buying a little higher than that. Our average price on our current trade is 288. We're in that trade right now, which is just slightly above where we are at the moment. We're at 281 now, so 7 cents higher. This is the weekly chart. Now, you'll need to watch my video, which I put up a few minutes ago, an hour ago or 2 hours ago, where I described this pattern to you and why I think this is important. And I'll give you 30 seconds here, but you can look at the video for another two minutes in addition to that. There's the 50-day moving average. Is always a key level on day charts, on any instrument, on week charts, sorry. And we're holding above the 50, even though the 50-period moving average is moving downwards and the price is moving downwards. We're still technically in an uptrend, because we haven't broken below the 50, which is weird, because the 50 is almost pointing down vertically. But we are above the 20, and the 200's way up here. So that's the kind of our target, the 200-period moving average. It's a natural target. If you're not sure what a target should be, just look for the 200-period moving average, and or whatever time frame you're looking at. It's normally a good zone. So that's at around, I'm going to say 350, 360. It's a little higher. That'll come down. So that's where we are on the weekly chart. And I think we've got support there. There's the 50% Fibonacci. We're at the channel bottom. We're above the 50-period moving average. And we've got the 20, which we've tried to pierce through this week. This is a weekly chart. So this bar represents an entire week. If we go to the daily chart, let's have a look at the 4-hour chart, and then I'll be done. And this is the 4-hour chart. And we came down. There's that same channel. There's the same Fibonacci level. But on the 4-hour chart, we're below all the moving average. So the short-term trend's down. The long term is technically still up. We've got that rising channel. We've got the 50 period moving average on the weekly. Technically, we're still in an uptrend, but in this period right now, we're in a downtrend on the 4-hour chart, and maybe we'll hold here. I think we have a 60% chance of holding this level. And as I said in my video, that's not much better than 50-50 or a coin flip. And that's all I can offer you at the moment.
That's part of the game, and that's part of the reason that that James and ArcisFX
all that, and it's
are
a
experts.
coin flip.
No, better than a coin flip, Bill. Better.
That's right.
Slightly better.
better than a coin flip.
So listen, folks, thanks so much. Really appreciate you joining. James, thanks so much for sticking around. I know it's a long day for you there, so really appreciate you. Bill, thanks for coming in. And what's the name of the shop again?
Oh, it's in the chat.
Yeah, so shout out to Taos Mountain Outfitters here, and I put it in the chat. It's in on the plaza in Taos, New Mexico, and go to their website or come by them. Great place, customer service.
Okay, fantastic. Well, listen, thanks so much, folks, and we will see you. We will see you next week. I'm not sure what we're going to talk about, but we will see you next week. So until then, have a great one.
Take care.